So I asked myself, is Alibaba a worse company because of this? Well, hey everyone, so I don't have time for much of an introduction here. We need to get into the meaty earnings report from Alibaba. So let's go. Okay, so here are the most recent numbers from Alibaba as of the end of Q4 2021. So we have annual active users worldwide up about 19% year on year. The local order volume, so that's inside of China, is up 22% year on year. International order volume is actually up 25% year on year. Now, total revenue is up only 10% year on year compared to 22% for the 9 months year on year. So revenue growth has slowed, and that's been an issue on the stock market, and that's what analysts have had the issue with. And everyone's also having issues with the earnings per share, which is down 74% year on year, and the free cash flow is also down 26% year on year. So this is the slowest ever revenue growth since Alibaba went public almost a decade ago, and shows that they faced a slowdown in growth at the end of 2021. So profit is down dramatically, and it looks ugly on the surface. But it actually isn't as bad as it would appear. So if we actually were to look at a better comparison, EBITDA, which is earnings before interest, taxes, depreciation, amortization, well, this is down at 25% or so. Now that's still quite dramatic. So what's going on? Is this just an amazing opportunity for us investors hunting for discounts, or is this something fundamentally wrong with the company? Okay, so after my research and thinking about this for a while, I think there are 4 main reasons for the decline in profit. So firstly, it is because of the weak macroeconomic outlook just in China. Both government and private sector data indicate that Chinese consumers have had a tough time, with retail sales and online sales slowing into the end of 2021. On top of this, restrictions linked to a surge in COVID-19 cases didn't help these last few months of the year. But is Alibaba a worse company because of all of this? Well, not at all. So the second reason I think is the tech sector is facing these anti-monopoly regulations from the government. The Chinese tech companies were just belted in 2021 from all the regulatory crackdowns by Beijing, which helped Alibaba lose almost 50% of its market value last year. Analysts tend to believe the worst is over, but what would they know? So I asked myself, is Alibaba now a worse company because of this? Well, maybe actually a little worse. The strong competitive position that they had has become a little weaker. I don't think it has collapsed the moat, but it is definitely a little weaker. The third reason is because of some decisions by Alibaba internally to waive the fees for their merchants to encourage an increase in retention on their platforms. This would represent a strategic choice to sacrifice short-term revenue in favor of long-term stability. So I asked myself, is Alibaba a worse company because of this? Well, not at all. Maybe even a better company because of these things. And the fourth reason I see is just simply the comparison to last year's numbers. Analysts and lots of investors as well love to look at year-on-year numbers. But this isn't exactly that fair considering the blockbuster 2020 e-commerce was having. The pandemic meant most people shopped online, which boosted revenue numbers. We all know this. So as things settled down in 2021, the comparison to 2020 probably isn't that fair. So let's take a look at simply the 2-year numbers for revenue. So we have 2019 revenue at about $60 billion US dollars, and 2021 revenue 2 years later at about $132 billion US dollars. Sure, growth has slowed from 2020 to 2021, but is the business a worse business by comparing 2020 to 2021? Well, not at all. It's more than doubled in 2 years. That's exceptional growth. I can't imagine seeing the business grow at these crazy speeds again, but the company is doing really well. It is a great business with a lot more people throughout the world starting to use their services. And by the way, if you want to see my most updated valuation on Alibaba based on these results with buy prices and appreciation potential, join my e-magazine through the link in the description. The new March edition is out today. I am writing this each month to update my watch list and share my thoughts about investing. It's about $10 a month for the e-magazine subscription, and take a look at my February edition to get a feel for what each issue will have included. All right, so now back to Alibaba. Now, expenses have gone up a lot as well in 2021. Alibaba are investing in the future of their business. So we're talking like marketing, research and development, stuff like that. Now this stuff hurts the profit figure as well. So that makes the numbers look worse on the surface too. They have too much cash anyway, so I like them trying to use it to grow. Otherwise, they should just pay a dividend, and if they run out of ideas, I'll take that dividend and invest it somewhere else. But anyway, they're not giving a dividend, and I hope they do reinvest their money in a good way. Now, there were some highlights that came out of the earnings call, and these were that international commerce grew at 18% year on year. This is good to see as Alibaba are expanding outside of China. This gives them more diversified revenue, which I like to see. Plus, the global market is a big place with a very big addressable market. And then cloud computing grew at 20% year on year. And another big addressable market with good growth that is not related to the pandemic. So looking at year on year numbers is actually okay for the cloud. Now, if you're not comfortable owning Alibaba on the New York Stock Exchange, you can purchase it in Hong Kong, but you will need a good broker to do that. And I recommend Interactive Brokers. It's the one that I use. And I use it because it's safe, it's reliable, and very affordable. I have demonstration videos here in my channel and in the link in the description, and you can take a look at a demo account to see if you like how it works. Now with Alibaba, when I take a look at the segments of the business that they have, the China domestic part of the business, which makes up over 60% of the revenue, is actually flat year on year. Now that has been the drag on the revenue. But remember, 2020 Q4 numbers were very strong, so equaling those numbers is, I think, more than acceptable. I think of it like if I was running the company, I would think things are going actually pretty well and excited for what we are building in the future. Screw what the stock price is doing. I would just focus on what we are doing to execute our plan. I would think that we are still a powerhouse and still the dominant player in China. I don't think the management team are losing any sleep over what is going on with the stock price. Now, I can't tell you what to do with your money, and I have no idea how low this is going to go. I wouldn't put my entire net worth in this, but I have bought aggressively already for myself, and I will try to add more soon. I actually hope the prices stay super low for a long time because I want to accumulate more and more. So I actually hope everyone doesn't start buying too aggressively anytime soon so I can build up some more. And there are still a lot of super investors invested in Alibaba. So we got Charlie Munger, he's the big name here, along with Robert Vinal, Guy Spear, Prem Watsa, and there's plenty of others. So I don't see any reason to abandon the ship. I'm on board and I'm pretty happy about that. Normally I thank a particular person from the community for being a legend in this part, but I have had so much support, so I'm simply appreciative to you all. I am safe, but I do have close friends and their family in Ukraine and Kiev right now. It has been a really difficult time and I thank you all for caring. Look, hopefully peace can come quickly and I can get back there and help rebuild. And making these videos and focusing on investing is good for my brain right now, so I'll have another video shortly and I will see you then.